Listen, I need you to pay very close attention to what I'm about to show you, because what's happening right now in the gold market is something I haven't seen in over 2 decades of analyzing precious metals. And if you have money sitting in a traditional IRA or 401k, the next 60 to 90 days could determine whether you preserve your wealth or watch it evaporate. 3 days ago, something extraordinary happened that most people completely missed. The World Gold Council released their Q3 central bank gold purchases report, and buried in that data was a number that made my jaw drop. Central banks added 337 tons of gold to their reserves in just the third quarter alone. That's not for the year. That's for 3 months. To put that in perspective, that's more gold than most countries hold in their entire national reserves. But here's what really matters. When I dug into who was buying, I found something that should terrify anyone holding dollars in their retirement accounts. China reported adding 23 tons. Poland grabbed 19 tons. The Czech National Bank picked up 5 tons. But then I noticed something strange in the data. There was a category called unreported purchases that accounted for over 180 tons. That means central banks are buying gold so aggressively that they don't even want to report it publicly because they don't want to spook the markets or tip off other buyers. Think about that for a second. The people who control the printing presses, the people who can create currency out of thin air, are converting that currency into physical gold as fast as they possibly can, and they're doing it quietly. Why would they do that unless they knew something catastrophic was coming? Now, I want to take you back to a moment in history that most people have forgotten. But that's playing out again right now in almost identical fashion. It was August 15th, 1971. President Nixon went on television on a Sunday night and told the American people that the United States would no longer convert dollars to gold. He called it temporary. He said it was necessary to protect America from speculators. But what really happened was that America had printed so many dollars to fund the Vietnam War and Great Society programs that foreign governments started showing up at the Treasury window demanding their gold back. France sent a battleship to New York Harbor to pick up their gold. Germany wanted their gold. Switzerland wanted their gold. And America simply didn't have enough gold to honor all those claims. So Nixon slammed the gold window shut. And what happened next? Gold went from $35 an ounce to $850 an ounce over the next 9 years. That's a 2,300% increase. People who saw that signal and moved their wealth into gold before the crowd figured it out preserved their purchasing power. Everyone else watched their savings get destroyed by inflation. Here's why I'm bringing this up. We're seeing the exact same pattern right now, except this time it's not just America that's in trouble. It's the entire Western financial system. Let me show you the evidence. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus about 40 other countries that have now joined or applied to join, are actively building a parallel financial system that bypasses the dollar entirely. They're settling trade in their own currencies. They're building their own payment systems. And at the center of this new system is gold. Not dollars. Gold. Saudi Arabia just let their 50-year petrodollar agreement with the United States expire in June. For half a century, Saudi Arabia agreed to sell oil only in dollars in exchange for U.S. military protection. That agreement created artificial demand for dollars worldwide because every country needed dollars to buy oil. Now that agreement is dead. Saudi Arabia is now accepting yuan, rupees, and even discussing gold-backed settlement systems. The United Arab Emirates just became a formal BRICS partner nation. They're one of the world's largest oil exporters. They're now part of a bloc that's explicitly trying to reduce dollar dependence. Do you see the pattern forming? But here's where it gets really interesting, and this is the part that most analysts are completely missing. The gold market isn't just about central banks buying physical metal. There's a massive structural problem in how gold is traded that's about to explode. And when it does, the price of gold is going to move so fast that most people won't be able to react in time. Let me explain how this works. Most gold trading happens on the COMEX, which is the Commodities Exchange in New York. When you see the gold price quoted on financial news, that's the COMEX price. But here's the dirty secret about COMEX. For every ounce of physical gold in COMEX warehouses, there are roughly 100 ounces of paper gold contracts trading. That means the price of gold is being set by paper contracts, not by actual physical metal. This works fine as long as everyone's playing the paper game. But what happens when someone shows up and demands physical delivery? That's when the system breaks. And that's exactly what's starting to happen right now. In the last 6 months, we've seen physical gold flowing out of COMEX warehouses at an accelerating rate. Registered gold, that's gold that's available for delivery, has dropped from over 15 million ounces to under 10 million ounces. Meanwhile, open interest, which represents the number of contracts that could demand delivery, is sitting at over 500,000 contracts. Each contract represents 100 ounces. Do the math. That's 50 million ounces of potential delivery claims against 10 million ounces of available gold. Now, most of those contracts will get rolled forward or settled in cash. That's how the game has always worked. But what happens if just 20% of those contracts demand physical delivery? The system doesn't have the gold. It's not there. And when that becomes obvious to the market, the price of gold is going to gap up so violently that it'll make your head spin. We're already seeing cracks in the system. In March of this year, several major gold dealers in London reported that they couldn't source physical gold bars to meet delivery obligations. They had to pay premiums of $50 to $70 per ounce above the spot price just to find metal. That's not supposed to happen in a functioning market. That's a shortage signal. The Shanghai Gold Exchange, which is where physical gold trades in China, has been consistently trading at a premium to COMEX for the last 18 months. Right now, that premium is running between $30 and $40 per ounce. That means Chinese buyers are willing to pay significantly more than the Western paper price to get their hands on actual metal. Why? Because they understand that physical gold in your possession is worth more than a paper promise from a Western bank. Now let me connect this to your retirement account because this is where most Americans are completely exposed and don't even know it. If you have a traditional IRA or 401k, your wealth is sitting in paper assets, stocks, bonds, mutual funds, all of it denominated in dollars, all of it dependent on the continued stability of the U.S. financial system and the dollar's role as the world's reserve currency. But what we're watching happen in real time is the slow motion collapse of that system. It's not going to happen overnight. It's going to happen in stages. First, foreign central banks reduce their dollar holdings. We're seeing that. Then, international trade starts settling in other currencies. We're seeing that. Then, the demand for U.S. Treasury bonds starts to decline because foreign buyers don't need as many dollars. We're seeing that too. Treasury yields have been climbing despite the Fed's attempts to control them. And here's what happens next. As demand for dollars decreases, the value of the dollar falls. As the value of the dollar falls, inflation accelerates. And as inflation accelerates, the purchasing power of your retirement savings evaporates. You might have $1 million in your IRA, but if that $1 million can only buy what $500,000 buys today, you've lost half your wealth. This is why gold matters. Gold isn't an investment. It's insurance. It's the only asset that has maintained its purchasing power across centuries, across empires, across every currency collapse in human history. An ounce of gold bought a fine men's suit in Roman times. An ounce of gold buys a fine men's suit today. That's 2,000 years of purchasing power stability. Quick aside here, because this is important. If you're sitting on $100,000 or more in a traditional retirement account, you need to understand that you can move a portion of that into physical gold without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. It's in the description below. It covers the rollover process, the custodian requirements, the storage rules, all of it. If you're concerned about what I'm showing you here, that guide is worth your time. All right, back to what's happening in the market right now, because the timeline on this is compressing faster than most people realize. 2 weeks ago, JP Morgan released an internal research note that got almost no mainstream media coverage. In that note, their commodity strategists projected that gold could hit $3,000 per ounce by the end of 2025. Now, JP Morgan doesn't make predictions like that lightly. They're one of the largest players in the gold market. They have more information about physical flows, central bank activity, and institutional positioning than almost anyone. When they put out a $3,000 price target, they're not guessing. They're seeing something in the data. But here's what I think they're not saying publicly. I think $3,000 is conservative. I think we could see $4,000 or even $5,000 in the next 18 to 24 months. And here's why. The U.S. national debt just crossed $36 trillion. We're adding $1 trillion to that debt every 100 days now. That's not sustainable. Everyone knows it's not sustainable. The only way out is to either default on the debt, which would destroy the dollar's credibility overnight, or to inflate the debt away by printing massive amounts of new currency. Both options are catastrophic for anyone holding dollar-denominated assets. Meanwhile, the federal government is running a deficit of over $2 trillion per year. That means we're spending $2 trillion more than we're collecting in taxes every single year. Who's buying all that debt? Well, it used to be foreign central banks. But foreign central bank holdings of U.S. treasuries have been declining for 3 straight years. China has reduced their treasury holdings by over $300 billion. Japan, our largest foreign creditor, has been selling treasuries to defend the yen. So if foreign buyers are stepping back, who's left? The Federal Reserve, which means the Fed has to print new dollars to buy treasury bonds to fund government spending. That's the definition of monetary debasement. And every time they do that, the dollars in your bank account and your retirement account become worth less. Now let me show you something that's happening right now that almost nobody is talking about. The commercial banks, the big players like J.P. Morgan, Goldman Sachs, and Citibank, have been massively short gold on the COMEX for years. They've been betting that the price would go down or stay flat. That's how they make money in the paper gold market. They sell contracts they don't have the metal to back, collect premiums, and hope the price doesn't rise. But look at what's happened in the last 6 months. The commercial short position has been shrinking dramatically. These banks are covering their shorts, they're buying back contracts, they're reducing their exposure. Why would they do that? Unless they thought the price was about to move sharply higher. They have the best information in the market. They see the physical flows. They know what central banks are doing, and they're getting out of the way. At the same time, the large speculators, the hedge funds, and commodity trading advisors have been building long positions. They're betting on higher prices. And the small speculators, the retail traders, are still mostly on the sidelines. That's the perfect setup for a major price move. When the retail crowd finally figures out what's happening and rushes in, that's when you get the parabolic move that takes gold from $2,600 to $4,000 in a matter of months. Let me give you a historical parallel that shows you how fast this can happen. In 2011, gold was trading around $1,500 in July. By September, just 2 months later, it hit $1,900. That's a 27% move in 8 weeks. What triggered it? The U.S. debt ceiling crisis and the downgrade of U.S. credit rating by Standard & Poor's. Suddenly, people realized that U.S. government debt wasn't as safe as they thought, and they rushed into gold. We're facing a much larger crisis now. The debt is twice as high. The deficits are bigger. The geopolitical tensions are worse. And the dollar's reserve currency status is under direct attack from half the world's population. When this breaks, the move in gold is going to make 2011 look like a warm-up. But here's the part that should really concern you if you're a retiree or near retirement. You don't have time to recover from a major wealth destruction event. If you're 35 years old and your portfolio drops 50%, you have 30 years to make it back. If you're 65 years old and your portfolio drops 50%, you're done. You don't have 30 years. You might not even have 10 years. You need to preserve what you have right now. And that's why the signal we're seeing from central banks is so critical. These institutions don't buy gold because they think it's going to make them rich. They buy gold because they know it's the only asset that will survive what's coming. When the Bank of China buys 23 tons of gold in a single quarter, they're not speculating. They're protecting their reserves from dollar devaluation. When Poland adds 19 tons, they're not gambling. They're preparing for a monetary system reset. The smart money is moving. The question is, are you going to move with them? Or are you going to wait until everyone else figures it out and the price has already doubled? Let me show you one more piece of evidence that ties all of this together. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting at around 84 to 1. Historically, that ratio averages around 60 to 1. When the ratio gets this high, it means gold is expensive relative to silver, or silver is cheap relative to gold. But here's what's interesting. In every major monetary crisis, that ratio compresses violently. In 2011, it dropped from 80 to 1 down to 32 to 1 in just a few months. Why? Because when people panic about the currency system, they buy both gold and silver, but silver moves faster because it's more affordable and more volatile. If we see a similar compression this time and gold goes to $4,000, silver could easily hit $80 or $100 per ounce. It's currently trading around $31. The point is, we're at the beginning of a major monetary shift, not the end. The signals are everywhere if you know where to look. Central bank buying at record levels, physical shortages in major markets, commercial banks covering their short positions, geopolitical realignment away from the dollar, unsustainable debt levels. All of it points to the same conclusion. The dollar's purchasing power is going to decline significantly over the next few years, and the only question that matters is whether you're going to protect yourself or not. Now, I want to address something that I hear all the time from people who are skeptical about gold. They say, gold doesn't pay dividends. It doesn't generate income. Why would I own it? And that's a fair question if you don't understand what gold actually is. Gold isn't supposed to generate income. Gold is supposed to maintain purchasing power. It's supposed to be the stable foundation of your wealth that doesn't fluctuate with the whims of central bankers or the competence of politicians. Everything else in your portfolio, your stocks, your bonds, your real estate, those are your growth assets. Gold is your insurance policy. Think of it this way. You pay for homeowners insurance every year, right? That insurance doesn't generate income. It doesn't appreciate in value, but you pay for it anyway because you understand that if your house burns down, that insurance is the only thing standing between you and financial ruin. Gold works the same way. When the monetary system burns down, gold is what protects you. And we're not talking about putting 100% of your wealth into gold. We're talking about a strategic allocation. Most financial advisors who understand monetary history recommend somewhere between 10% and 20% of your portfolio in physical precious metals. That's enough to protect you if things go wrong, but not so much that you miss out on growth if things go right. But here's the critical part. It has to be physical metal that you control or that's held in a secure, allocated storage facility in your name. Not paper gold, not gold ETFs, not gold mining stocks. Physical metal. Because when the system breaks, paper promises are worthless. Only physical metal in your possession or in allocated storage will protect you. I've been studying the gold market for over 20 years, and I've never seen a setup like this. Every indicator, every data point, every historical parallel is screaming that we're on the verge of a major repricing of gold relative to fiat currencies. The central banks know it, the commercial banks know it, the sovereign wealth funds know it. The only people who don't know it yet are the general public. And that's actually good news for you, because it means you still have time to act before the crowd figures it out. Once gold breaks above $3,000 and stays there, once the mainstream media starts running stories about the gold rush, once your neighbors and co-workers start talking about buying gold, it'll be too late to get in at reasonable prices. The premiums will spike. The dealers will run out of inventory. The wait times will stretch to months. Right now, you can still buy gold at relatively normal premiums. You can still get delivery in a reasonable time frame. You can still move retirement funds into a gold IRA without competing with millions of other people trying to do the same thing. But that window is closing. Let me paint you a picture of what I think is going to happen over the next 12 to 18 months. The Federal Reserve is going to be forced to choose between fighting inflation and preventing a recession. They can't do both. If they keep interest rates high to fight inflation, they're going to crash the economy and trigger a wave of corporate defaults and bank failures. If they cut rates to prevent a recession, they're going to reignite inflation and destroy the dollar's purchasing power. Either way, gold wins. In a deflationary crash, gold holds its value while everything else collapses. In an inflationary spiral, gold rises in nominal terms to maintain its purchasing power. That's why central banks hold gold. It's the only asset that protects you in both scenarios. And here's what I think is the most likely outcome. The Fed is going to try to thread the needle. They're going to cut rates just enough to keep the economy from collapsing, but not enough to fully reignite growth. We're going to end up in a stagflationary environment where growth is weak but inflation remains elevated. That's the worst possible scenario for traditional financial assets. Stocks struggle because earnings are weak. Bonds get crushed because inflation erodes their value. Real estate becomes illiquid because nobody can afford the mortgages. But gold thrives in stagflation. We saw it in the 1970s. From 1971 to 1980, the U.S. economy was stuck in stagflation. GDP growth was weak, unemployment was high, but inflation was running at 10% to 15% per year. The stock market went nowhere for a decade, but gold went from $35 to $850. If you had 20% of your portfolio in gold during that period, you not only preserved your wealth, you actually grew it while everyone else was getting destroyed. We're setting up for a similar period right now. The debt levels are higher. The monetary debasement is more extreme. The geopolitical situation is more unstable. And the dollar's reserve currency status is under direct attack. All of that points to a stagflationary outcome that's going to be devastating for traditional portfolios, but incredibly bullish for gold. So here's what you need to do. First, educate yourself. Understand what's happening in the monetary system. Understand why central banks are buying gold. Understand the difference between physical metal and paper promises. Second, assess your current portfolio. How much of your wealth is in dollar-denominated paper assets? How exposed are you to a dollar devaluation or a stock market crash? Third, make a plan. Decide what percentage of your portfolio you want to allocate to physical precious metals. And fourth, execute that plan before the crowd figures out what's happening. If you're sitting on a significant retirement account, $100,000 or more, you need to understand your options for moving a portion of that into physical gold without triggering taxes or penalties. That's what a gold IRA allows you to do. It's a self-directed IRA that holds physical precious metals instead of stocks and bonds. The metal is stored in an IRS-approved depository in your name. You maintain the same tax advantages as a traditional IRA, but your wealth is protected by physical metal instead of paper promises. I put together a comprehensive guide that walks through the entire process. It covers how to choose a custodian, how to fund the account, how to select the right metals, how storage works, all of it. That guide is linked in the description below. If what I've shown you here resonates with you, if you're concerned about the direction of the dollar and the stability of the financial system, that guide is the next step. The signal is clear. Central banks are buying gold at record levels. Physical shortages are appearing in major markets. The commercial banks are covering their shorts. The geopolitical realignment is accelerating. The debt levels are unsustainable. And the dollar's reserve currency status is under attack. All of it points to a major repricing of gold in the very near future. The question isn't whether gold is going higher. The question is whether you're going to position yourself before it happens or after. The retirees who see this signal and act on it are going to preserve their wealth and maintain their standard of living. The ones who ignore it or wait too long are going to watch their purchasing power evaporate as the dollar declines. This is your moment to pivot. This is your moment to take action. Don't wait until gold is at $4,000 and everyone's talking about it. By then, the opportunity will be gone. The time to move is now, while you still can, while the premiums are reasonable, while the inventory is available, while you can still get your retirement funds repositioned without competing with millions of other people trying to do the same thing. The smart money has already moved. The central banks have already moved. The sovereign wealth funds have already moved. Now it's your turn. Protect what you've spent a lifetime building. Secure your retirement. Preserve your purchasing power. Get the guide. Understand your options. And make the move before it's too late.